Good evening. Tonight, 5 major corporations have announced plans to exit the United States, blaming Trump-era tariffs for their decision. This isn't just about headlines, it's about jobs, communities, and the future of American manufacturing. We'll break down which iconic companies are leaving, why, and what it means for thousands of American workers. The story is complex, involving billions of dollars, global supply chains, and policies that have reshaped the economic landscape. Let's get started. Let's begin with General Motors, a symbol of American manufacturing. GM's decision to shift operations overseas is the result of years of mounting pressure, with Trump-era tariffs on steel and aluminum acting as the final straw. These tariffs dramatically increased the cost of building vehicles in the U.S., making domestic production far less competitive. The price of essential raw materials skyrocketed, squeezing profit margins and forcing GM to reconsider its manufacturing footprint. The impact rippled through the supply chain, hurting smaller American parts suppliers and local economies. GM couldn't simply absorb or pass on these costs without risking sales in a fiercely competitive global market. Facilities in Mexico and Canada became more attractive, not just for cheaper labor, but to escape the high cost of U.S. raw materials. This wasn't about abandoning American workers, it was about survival in a globalized economy. The tariffs, meant to protect U.S. steel, ended up making American factories more expensive and less viable. When a major plant moves, it affects not just workers but entire communities, local businesses, schools, and tax bases. Ultimately, GM's move was a necessary step to remain competitive, a stark example of policy colliding with economic reality. The story of GM shows how a single policy can send shockwaves through an interconnected economy. Tariffs designed to help one industry can devastate another, leaving American icons with impossible choices. The departure of GM leaves a void that's hard to fill. It's a powerful lesson in the unintended consequences of economic intervention. The numbers became impossible to ignore. GM's decision was controversial but framed as essential for long-term survival. The tariffs reshaped the landscape, forcing a strategic pivot. This is policy meeting reality on the factory floor, and it's just the beginning. Now let's turn to Harley-Davidson, a brand synonymous with American freedom and rebellion. Their decision to move some production overseas shocked many, but it was a direct response to the trade war. Harley faced rising costs for domestic steel and aluminum, slashing profit margins on every US-built bike. Then came the EU's retaliatory tariffs, which made American-made Harleys thousands of dollars more expensive in Europe. The company faced a choice: absorb massive losses or pass costs to customers and lose sales. The solution? Build bikes for Europe outside the US, sidestepping the tariffs. Critics accused Harley of abandoning its roots, but the company argued it was adapting to survive. This wasn't about chasing cheap labor, it was about escaping punitive trade barriers. Ironically, a policy meant to protect American industry forced an iconic brand to move production abroad. The global supply chain is complex, and made in the USA became a liability in a weaponized trade environment. Harley's leaders were vocal: tariffs made their business model unsustainable. The choice was stark: move production or lose a key market. Harley's story is a case study in the unintended fallout of protectionist policies. In a global economy, every action has a reaction. US tariffs led to EU retaliation, and Harley was caught in the crossfire. The company's move was about survival, not betrayal. It's a vivid example of how trade wars can backfire on the very industries they aim to protect. Harley-Davidson's decision highlights the risks of disrupting global trade. The brand's identity was tested, but the business had to adapt. Sometimes survival means making tough, unpopular choices. Our third company, Caterpillar Inc., is a global giant in construction equipment. Caterpillar's international reach made it especially vulnerable to the US-China trade war. China, a key market, responded to US tariffs with its own, targeting American-made machinery. Suddenly, Caterpillar's products became far more expensive in China, giving rivals like Komatsu a major edge. The financial hit was immediate: hundreds of millions lost, and a direct blow to Caterpillar's bottom line. To stay competitive, Caterpillar shifted production of some machines to facilities in Asia, bypassing tariffs. This wasn't about closing US factories overnight, but about redirecting growth and investment abroad. The expansion that might have happened in Illinois now happened overseas. The tariffs made the US a less attractive base for exporting to China. For American workers, this meant fewer new jobs and less investment at home. The slow erosion of US manufacturing capacity was driven by the need to avoid trade war crossfire. Caterpillar's story shows how retaliatory tariffs can hurt the very exporters they're meant to help. The goal was to punish China, but the result was a major American company moving production out of the US. Modern manufacturers have global networks and can shift production quickly. When one country becomes too costly, business flows elsewhere. The ripple effects are real: lost jobs, stalled growth, and weakened communities. Caterpillar's experience is a warning about the risks of trade wars. Every policy move has a countermove, and American companies often pay the price. The lesson in global trade: protectionism can backfire. The dance of tariffs and retaliation rarely ends well for anyone. Whirlpool, a staple in American homes, offers a different perspective. Initially, Whirlpool lobbied for tariffs to protect against foreign competition. The administration delivered, imposing steep tariffs on imported washing machines and components. At first, it seemed like a win for Whirlpool, until the reality of global supply chains set in. While Whirlpool assembles appliances in the US, many parts are sourced internationally. Tariffs on steel, aluminum, and components drove up production costs across the board. The company faced a dilemma: absorb higher costs or raise prices for consumers. They chose to raise prices, impacting not just foreign brands, but Whirlpool's own products. Studies found tariffs did little to boost Whirlpool's market share, but cost American consumers billions. The initial advantage faded as costs soared, forcing Whirlpool to reconsider its US manufacturing strategy. The idea of moving operations abroad became a real option. The tariffs, meant to help, ended up making foreign production more appealing. Whirlpool's case reveals the hidden complexity of modern manufacturing. Made in the USA often means assembling global parts. Disrupting supply chains with tariffs can hurt domestic producers. The policy meant as a lifeline became a burden. Higher costs, higher prices, and little competitive gain. Whirlpool's story is a cautionary tale. Sometimes protectionism hurts those it's meant to protect. Finally, Ford Motor Company, an American icon, faced its own tariff-driven challenges. Steel and aluminum tariffs alone cost Ford about $1 billion in profits, making US production more expensive. The trade war created deep uncertainty, complicating long-term planning and investment. Ford's plan to import the Focus Active from China was scrapped after a 25% tariff made it unprofitable. Building it in the US wasn't viable either, so the car simply disappeared from the American market. Tariffs didn't bring jobs back, they just reduced consumer choice. Facing rising costs and instability, Ford accelerated investment outside the US, especially in Europe and China. This was about survival, not a lack of patriotism. Ford needed to hedge against volatility and high costs at home. The company diversified its manufacturing footprint, insulating itself from US-centric trade disputes. Tariffs influenced everything, from sourcing parts to R&D and electric vehicle plans. Instead of making America more attractive for manufacturing, tariffs pushed Ford to invest abroad. Ford, like GM, faced immense pressure from both higher costs and global uncertainty. The decision to expand overseas was a direct response to the new environment. The story is clear: trade policy reshaped Ford's global strategy. Higher costs and chaos at home forced tough choices. Ford's move was about long-term health and competitiveness. The lesson in a global market: stability and cost matter most. What's the cumulative impact of these corporate exits and shifts? It's a story of real-world consequences for American workers and communities. The US manufacturing base is eroding, and global competitiveness is at risk. Tariffs, meant as a shield, have acted as a sword, driving iconic companies to seek stability elsewhere. These decisions will ripple for years, affecting jobs, prices, and local economies. The debate over trade policy continues, but the foundation of American industry has been shaken. The future remains uncertain. Stay tuned for more on this developing story.